Beginning in September of 2024 and continuing through December of the same year, the Federal Reserve cut the Fed funds rate by a full 100 basis points. What's striking, though, is that during the same stretch, longer-term rates actually climbed. U.S. 10-year yields jumped from 3.7% in mid-September to a cycle high of 4.8% by early January. The market seemed to take this as a sign that maybe the Fed moved too quickly. Inflation concerns had resurfaced. Some looked at the new administration's trade policies, others pointed to domestic initiatives that could fuel growth and make cuts unnecessary. Either way, the Fed appeared to notice, putting its rate-cutting cycle on hold for the past 8 months. Now things are shifting again. We're just 4 weeks from the next Fed meeting, and the CME FedWatch tool shows an over 80% chance of a 25 basis point cut. The big question, though, is will that push longer-term rates higher on inflation worries or lower on fears of economic weakness? Now, we got an early clue on August 1st. Weak employment data surprised the market. Expectations for a renewed easing surged. 2-year yields tumbled from 3.9% to 3.68%, and the 10-year yields moved lower as well, from 4.37% to 4.2%. Many analysts saw this as a clear message. The bond market is more worried about a weakening labor market than runaway inflation. Now, there have been a few curveballs like the hotter-than-expected PPI print on the 14th, but even that couldn't break 10-year yields out of their range. And now, all eyes are on the Jackson Hole Symposium, with Chairman Powell set to speak on Friday, August 22nd. Markets will be hanging on every word for signs of a pivot toward more dovish policy. Now, if a trader believes that yields are going higher from here, they could express that by buying the August 10-year yield contract at 4.30 and targeting a move back to the May highs of 4.60. Now, a stop for this trade could be placed below at 4.15. This trade can make $300 if the target is reached and risks $150 if you're stopped at your level. Now, if a trader believes that yields will fall from here, they could sell the August 10-year yield contract at 4.30 and target a move back to the April lows of 3.70. Now, a stop for this trade can be placed above at 4.70. This trade can make $600 if the target is reached and risks $400 if you're stopped out of your level.